The bear case: macroeconomic headwinds and credit vulnerabilities. The bearish perspective on Capital Southwest emphasizes the cyclical risks inherent in a specialty finance model that is heavily exposed to interest rate fluctuations and the credit health of smaller, leveraged borrowers. As the financial markets transition into a potential period of monetary easing in 2026, the corporation's higher-for-longer tailwinds may become headwinds. Interest rate sensitivity and NII compression. The vast majority of Capital Southwest's credit portfolio, approximately 99%, consists of floating-rate debt investments linked to SOFR. While this positioning was highly profitable during the Federal Reserve's tightening cycle, it exposes the corporation to significant NII erosion if rates decline. Based on the interest rate sensitivity analysis provided in the February 2026 10Q, the annual and per-share impacts of base rate changes are estimated as follows.
25 BPS change, plus $3.7 million annual NII impact, plus 0.06 per share. Negative 25 BPS change, negative $3.7 million annual NII impact, negative 0.06 per share. Negative 50 BPS change, negative $7.4 million annual NII impact, negative 0.12 per share. Negative 75 BPS change, negative $11.1 million annual NII impact, negative 0.19 per share. If the Federal Reserve reaches a terminal rate of 2.9% by the second half of 2026, as some economists predict, Capital Southwest could face a situation where its NII coverage of the regular dividend becomes marginal. This sensitivity is compounded by the fact that the corporation has been refinancing its own fixed-rate debt. In late 2025, the corporation redeemed $150 million of 3.375% notes and $71.9 million of 7.75% notes, replacing them with $350 million of 5.95% notes due 2030.
Emerging credit stress and non-accrual trends. While the portfolio's overall health remains high, with 89.7% of debt investments rated in the top two categories, there are emerging signs of credit stress. Non-accruals, which represent investments that are no longer paying interest, increased to 1.5% of the portfolio at fair value in the December 2025 quarter, up from 1.0% in the prior quarter. At cost, non-accruals stood at 3.2%, representing approximately $29.2 million in fair value. The lower middle market segment is particularly sensitive to stagflationary pressures. Companies with EBITDA between $3 million and $25 million often lack the bargaining power of larger enterprises and may struggle to pass on rising labor or input costs. The broader macro backdrop of 2026, characterized by surging oil prices and geopolitical conflict, could exacerbate these pressures, particularly in sectors such as consumer products and restaurants, which carry a higher average leverage of 4.2x.
Valuation premium and market sentiment risks. Capital Southwest often trades at a significant premium to its NAV, a valuation metric that bears caution. At a share price of approximately $22, the stock commands a P to NAV ratio of roughly 1.3x to 1.5x, significantly higher than the peer average for smaller or externally managed BDCs. This premium suggests that the market has already priced in a high level of operational perfection. If the corporation were to experience a significant credit failure or a cut to its supplemental dividend, the resulting multiple compression could lead to a sharp decline in the stock price, even if the underlying NAV remains relatively stable. Analyst sentiment in early 2026 has become more mixed, with some firms issuing sell equivalents due to declining EPS estimates, even as the brokerage consensus remains a moderate buy.
The bull case: structural efficiency and strategic alpha generation. The primary thesis for a bullish outlook on Capital Southwest is predicated on its internal management model, which offers a transparent and efficient alternative to the fee-heavy structures of externally managed BDCs. By employing its management team directly rather than paying an external advisor, the corporation effectively eliminates the standard 1.5% to 2% base management fee and 17.5% to 20% incentive fee structures typical of peers like Ares Capital or FSKKR. Internal management and operating leverage. The financial impact of this internal structure is most evident in the corporation's operating leverage.
For the 12-month period ending December 31, 2025, Capital Southwest reported an operating leverage ratio of 1.7%, which sits significantly below the BDC industry average of approximately 2.6%. This lean operational profile ensures that a higher percentage of total investment income is converted into net investment income, or NII, which is the primary driver of dividend distributions. Management has indicated a long-term target of reducing this leverage further to 1.5% or below as the portfolio continues to scale, a move that would further enhance the corporation's competitive advantage during periods of margin compression.
The alignment of management's interests with those of shareholders is further evidenced by insider activity. Throughout 2024 and 2025, various directors and managing directors, including Christine Batiste and Ramona Lynn Rogers-Windsor, engaged in open market purchases of common stock, signaling institutional confidence in the firm's underwriting and capital allocation strategy. Accretive capital market strategy and NAV enhancement. Capital Southwest has mastered the art of accretive scaling through its use of an equity at the market ATM program. By consistently trading at a premium to its net asset value, often exceeding 125% PNAV, the corporation can issue new shares that are immediately accretive to the NAV of existing holders. During the fiscal third quarter of 2026, the firm raised $52.6 million in gross equity proceeds through its ATM program at a weighted average price of $21.11 per share, representing approximately 127% of the prevailing NAV of $16.75.
In the Q3 2026 period alone, ATM issuance and related capital activities contributed significantly to the sequential increase in NAV per share from $16.62 to $16.75. This ability to raise capital at a premium provides the corporation with a lower cost of equity, which it can then deploy into high-yielding debt investments with a weighted average yield of 11.3%. The First Out Senior Loan Joint Venture. A major catalyst for the fiscal 2026 outlook is the formation of a 50-50 joint venture, JV, with an unnamed private credit asset manager to operate an off-balance sheet private fund. This venture is designed to target first-out senior secured debt opportunities in the lower middle market, providing the corporation with a vehicle to access larger, high-quality deals that might otherwise exceed its internal hold limits. The JV structure is particularly clever as it enables the use of targeted leverage, typically aiming for fund-level leverage of 2.5x, to generate low to mid-teens equity returns for Capital Southwest. By acting as the originator and administrator of the JV, Capital Southwest earns outsized economics and management-like fees, which are expected to buffer NII as base interest rates decline.
Each partner has committed $50 million of equity to the fund, which is expected to ramp up to full deployment within 1 year. Dividend Sustainability and Undistributed Taxable Income, UTI. Capital Southwest has maintained a highly shareholder-friendly distribution policy, transitioning in July 2025 to a monthly regular dividend to provide more frequent cash flow to its investor base. The sustainability of this payout is supported by a robust cushion of undistributed taxable income. As of December 31, 2025, the estimated UTI was $1.02 per share, reflecting consistent realization activity in the equity co-investment portfolio. Over the trailing 12 months, the corporation harvested $44.5 million in realized gains from equity exits, which fuels the spillover income used for supplemental dividends. Following the quarter end, an additional $6.8 million gain was realized from another equity exit, ensuring the supplemental dividend remains well covered into the future. Financial analysis and portfolio composition. The robustness of Capital Southwest is built upon a granular and diversified portfolio that mitigates idiosyncratic risk by limiting exposure to any single company to less than 1% of the total credit portfolio. As of the end of the 2025 calendar year, the portfolio was distributed across 132 companies in over 20 industries. Sector distribution and concentration. The fair value concentration of the portfolio is diversified across several key sectors: healthcare services, 13%, consumer products, 10%, media and marketing, 9%, consumer services, 9%, other industries, 20+, 59%. The concentration of 99% in first lien senior secured debt is a critical defensive pillar. In a bankruptcy scenario, first lien lenders are the first to be repaid, providing a safety net.
As of the Q3 2026 update, second lien debt and subordinate debt represented only 0.8% and 0.1% of the portfolio, respectively.
Capital structure and debt maturity profile. On the capitalization front, the corporation has maintained an investment-grade rating from Moody's Baa3 and Fitch BBB-, facilitating access to unsecured debt markets. The regulatory debt-to-equity ratio ended the 2025 year at 0.89x, providing ample dry powder to fund new originations without violating the 2.0x regulatory cap. Liquidity remains robust, with $458 million in total availability as of December 31, 2025. The debt profile includes September 2030 notes, 5.95% interest rate, maturing in 2030. SPV credit facility, term SOFR plus 2.50% interest rate, maturing in 2027, revolving. Corporate credit facility, variable interest rate with various maturities. SBA debentures, low-cost government fixed rates with various maturities.
Strategic risk management, AI and technological disruption. A notable underwriting focus is the corporation's evaluation of artificial intelligence, AI risk. Management has formed an internal AI committee to evaluate investments for their vulnerability to AI-driven disruption. This committee assesses how AI could impact competitive moats or revenue models in sectors like media and marketing and business services. Incorporating AI risk ratings directly into the investment committee review process demonstrates a level of sophistication in risk management, attempting to future-proof the portfolio against technological shifts.
Peer comparison. Estimated 2026 metrics. Capital Southwest. PE ratio 213.3x. Efficiency ratio 10.9%. Return on equity, ROE 10.4%. Main Street Capital, PE ratio 215.6x, efficiency ratio 8.2%. Hercules Capital, PE ratio 210.6x, efficiency ratio 15.4%, return on equity, ROE 16.8%. Main Street Capital remains the leader in operational efficiency with an 8.2% ratio, but Capital Southwest's 10.9% is highly competitive. Hercules Capital boasts a higher ROE at 16.8%, reflecting its specialized tech/life sciences lending model, whereas Capital Southwest's broader focus provides more diversified exposure to the general industrial economy.
Conclusion. Capital Southwest has optimized its internal structure to deliver high-quality income to its shareholders. The bull case is robust, supported by a unique management model, a creative equity issuance, and a high-yielding portfolio with significant embedded equity gains. The strategic pivot into a first-out joint venture represents a forward-thinking attempt to maintain returns in a lower-rate environment. However, the bear case cannot be ignored. The corporation's extreme sensitivity to interest rates means that a shift in Federal Reserve policy could quickly compress its earnings power. Furthermore, the recent uptick in non-accruals, though still low in absolute terms, indicates that the credit cycle is maturing, and the risks of the lower middle market may be coming to the forefront. Ultimately, Capital Southwest represents a premium yield play that requires careful monitoring of two variables: the trajectory of base interest rates and the stability of LMM credit quality. While the corporation's internal structure and UTI cushion provide a meaningful buffer, the high valuation premium leaves the stock sensitive to any deviation from its historical performance standards. The performance in the latter half of 2026 will be defined by Capital Southwest's ability to manage the transition from a high-rate windfall to a more normalized and competitive lending environment.